Why buying properties on your own doorstep is a huge mistake. Lots of people think it's smart to have properties local to you so you can check them, keep an eye on them, keep an eye on your tenants. You don't need to do that. Let's take a comparison against stocks and shares. If you wanted to buy some stocks and shares, you're not necessarily going to buy Morrison stocks and shares because that company's local to you, for example. It doesn't make sense. It's all down to the financials. So what you would do is you want to be buying properties that make financial sense in the right areas. And as long as you've got the right power team, the right letting agents, builders, things like that in that area, then that is a solid way of building a property portfolio. Not doing it the way most people think about emotionally, because you're not going to live in any of these properties. So let's do a comparison then. So on Rightmove, there's something called a comparison report. So let's click on this tab up here and put in a postcode. Let's give you one extreme to the other. So we're going to go with central London in Kensington. I'm going to pick a property out for sale. Let's pick this one bed. So this one bed in W8 postcode for 799,950. And then what we're going to do, we're going to compare that against a rental. So we need to find a one bed rental. There's one there. So get a calculator. And what we're going to do is we're going to work out the yield, the gross yield. So £3,033 per month times 12 divided by the purchase price times by 100 gives us a 4.5% gross yield. Now, gross yield is one of the metrics that we find properties to. If it doesn't it doesn't go above 7%, then we don't look at the property as a buy-to-let. If it was a flip or something like that, then that's different. But from a buy-to-let, it's got to be at least a 7% gross yield. Otherwise, we don't touch it, because when you put borrowing or lending or leverage on these properties, and as interest rates are going up at the moment, on a property like this is going to hurt you a lot more on properties like this than it is on a lower value property. So let's give you the other end of the scale, which would be a property in Liverpool, a hotspot investment area that we invest in. So let's just take this particular area of Liverpool. So we've got a property up for £105,000. And we've got a property up for rent, which is a 2-bed terrace. That's a 3-bed. Let's just see if we can expand the search radius to pick up on a 3-bed. There's no 3-beds for rent. Let's just go with the higher one we can see here, which is 700. So we're going to do 700 times 12 divided by 105,000 times by 100 gives you a respectable 8% gross yield. Now, even with this example I'm giving you on this one, we wouldn't be paying 105,000 for this property anyway. In our area, we get discounts and then we refinance and extract our capital. But it gives you an idea there. You're getting nearly a double return, because remember, you're getting 4.5% in Kensington gross yield. In London, in Liverpool, you're getting about 8%. So it's doubled. And this is one of the metrics you've really got to understand, the gross yield, because it's how profitable you're going to be after debt service. And I know what I'd rather invest in, these lower risk, higher return deals than central London. You'll get higher capital appreciation, no doubt, in Kensington. But if you're trying to build a portfolio up of properties, you're going to run out of cash very quickly buying them in London versus in Liverpool. And you can get your cash out very predictably, and it's very low risk. If you try and buy lots of them in London, like I've just shown you, those ones at 4.5%, with interest rates going up, you're going to soon have to start putting your hand in your own pocket to subsidise that asset. And that isn't a way to build a property portfolio. People who buy those types of properties in central London are typically foreign investors looking for safe havens for their money. They're certainly not for investment in a lot of cases. So this is why you should not always be buying properties on your own doorstep. It's subjective because it does depend on where you're located. But taking into account some of the things I've discussed, and we're looking at houses generally. If you've seen a lot of my content, I talk about buying freehold houses like this particular property, not flats. The one in central London, they have short leases, some of them, and they can be very expensive to extend. Service charges. If you need to do any conversion work to the property, substantial works, you need to get freeholder consent in some cases. So houses are much more investable, and certainly that north-south comparison there shows you exactly why all us investors and lots of London investors don't buy in London, they buy outside of London. If you're interested in working with us to build your property portfolio and your wealth, then just click in the description below. You'll find some details, and I'll speak to you all soon.